Tonight, I need you to pay attention because something just changed in the silver market that most people won't notice until it's too late. It wasn't announced with sirens. It wasn't framed like a ban. It didn't come with a headline that says, "Retail traders are no longer welcome." But functionally, that's exactly what happened. They just put a price tag on your ability to trade silver, $52,000. Not to buy silver, not to take delivery, not to build a long-term position, just to keep a standard futures position open without being forced out. They raised the number while you were living your life, while you were asleep, while you were busy working and paying bills. And if you don't understand why that matters, you're walking into a trap designed to turn regular traders into exit liquidity for institutions that can't afford to lose. Right now, you open your screen and you see silver trading around $115 an ounce. That's the number the paper market prints. That's the number the commentators repeat. That's the number that keeps you calm. But look beyond your screen and the story changes fast. Physical silver in parts of Asia and the Middle East is trading meaningfully higher, prices in the 130s, even around 140 in some reports, while the paper price still sits lower. That gap isn't a premium like you see on a coin shop website. A persistent $15 to $25 difference is the market screaming that something is wrong with price discovery. When the real thing costs more than the paper promise, you don't have one market anymore. You have two, one for claims, one for metal. And the moment that split becomes obvious, the rules stop being about fair trading and start being about controlling panic. Now, before anyone twists my words, I'm not telling you to bet your rent money on anything. This is not financial advice. I'm telling you to look at what's happening and ask the only question that matters. Why would the exchange suddenly make it dramatically more expensive to hold a long position in silver right as physical demand is getting louder? Because that's the part they hope you won't connect. Here's the setup. A standard COMEX silver futures contract represents 5,000 ounces. At 815s an ounce, that's $575,000 worth of silver, controlled by one contract. Futures are leveraged by design. You don't pay $575,000 to control it, you post margin, collateral. So the clearinghouse knows you can cover losses if the trade moves against you. And now, according to the new requirements being discussed, the maintenance margin is roughly $997 per contract. Call it $52,000. That's the figure that effectively decides who gets to stay in the arena and who gets pushed out. 3 weeks ago, traders were talking about margin around $20,000. Then it climbed $25,000, $32,500, and now $52,000. In less than a month, the cost of staying in the game more than doubled. Read that again, doubled. And don't underestimate how fast this can hit. A margin increase doesn't politely wait for you to log in. Your broker recalculates requirements immediately. If you're under the new threshold, you don't get a philosophical debate, you get a deadline. Sometimes it's hours, sometimes it's minutes. You can be right on the direction and still be forced to sell at the exact worst moment simply because the collateral rules moved. That's why this tool is so effective for anyone trying to cool a price run. It manufactures sellers. Also, remember there are usually two numbers: initial margin to open the position and maintenance margin to keep it open. If maintenance is near $52,000, initial can be higher and brokers can demand even more on top of the exchange minimum. So when people say you need 52 grand, they're often understating what a real trader will be asked to post in a fast market. The gate isn't just high, it keeps moving. When exchanges raise margin, they claim it's risk management. Sometimes it truly is. Volatility goes up, margin goes up. That's the official story. But history shows another reason. Margin hikes can be used as a circuit breaker to stop a runaway price move because they force participants to sell regardless of conviction. It's not a debate. It's math. If your broker calls and says, post more collateral or we close you out, then your opinion doesn't matter. Your thesis doesn't matter. Your analysis doesn't matter. Cash matters. And who has unlimited access to cash? The big players? Who doesn't? You. That's why this feels like a rule change mid-hand. Imagine you're in a casino, you finally start winning, and the house announces that the minimum bet is now 10 times higher. And by the way, you have to pay the new minimum immediately or you're out. They call it maintaining order. You call it what it is, a kill switch. And here's the part that should make your stomach tighten, the timing. There's a delivery report everyone is circulating dated January 26, 2026. If you've never looked at a delivery report before, don't worry, I'm going to translate what matters. Delivery is where futures stop being abstract and start being physical. It's the moment paper contracts get turned into metal moving from one account to another. According to the chatter around that report, January 2026 is shaping up as one of the largest silver delivery months on record, despite January not being a primary delivery month. The primary months are typically March, May, July, September, and December. January is supposed to be quiet, boring, routine, the kind of month no one makes videos about. And yet the numbers being quoted are huge. Around 9,529 contracts delivered with days still left in the month. Each contract is 5,000 ounces. That's tens of millions of ounces changing hands. In a month, that shouldn't be doing that. So what happens when even a small percentage of paper holders decide they want the real thing? That's when the system faces a test. And when systems face tests, they either adapt or they reveal their limits. This is why margin hikes matter. They're not just a number on a screen. They're a pressure valve. If too many longs hold on, the price can rise, forcing shorts to bleed. If margin hikes force longs to sell, the price can fall, giving shorts room to cover. It's a lever that changes who can stay at the table. Mike Maloney and other precious metals commentators have used the phrase kill switch for years, and the mechanism is straightforward. First, large entities build big short exposure over time. They sell paper silver they may not physically possess, because in a paper market, you can do that. Second, the price starts to rise. Third, margin requirements jump. Fourth, smaller players get forced out. Fifth, this forced selling pushes the price down. And sixth, the big shorts cover into the weakness and survive. That's the playbook people fear is unfolding right now. But here's the twist. That strategy depends on paper being the only game that matters. It assumes physical buyers accept paper pricing as reality. But what if physical buyers stop caring? What if they keep paying up for real metal no matter what the screen says? Then the paper smash becomes less effective. Because metal still leaves vaults, premiums still widen, leases still tighten, and the paper price becomes a headline, not a truth. Speaking of leases, lease rates are another signal that the metal now crowd watches like a hawk. The lease rate is essentially the cost to borrow silver. If you need physical urgently, you borrow it and pay a rate. In calm markets, those rates are low, fractions of a percent to a few percent. In stressed markets, they spike because the metal isn't easily available. People are saying silver lease rates have surged toward 8%. If that's even close, it's not normal. It means someone is willing to pay a hefty annualized cost just to get silver in hand. And then there's backwardation, the condition where spot prices are higher than futures prices. Normally, futures trade at a premium because of storage, financing, and time. When the spot price is higher, it's like the market is shouting, I want it now, not later. If you put those pieces together, delivery demand in an off month, shrinking inventory, rising lease rates, backwardation, widening physical premiums, margin hikes start to look less like risk controls and more like crowd control. Now, let me lighten the mood for a second, because this stuff can get heavy. I heard a story recently that made me laugh and also made my skin crawl. Someone said their Uber driver started talking about COMEX silver margins. Not crypto, not memes, not buy the dip. Silver futures maintenance requirements. If that's true, it tells you something important. When normal people start noticing the plumbing of markets, the people who run the plumbing get nervous. Because the entire paper machine works best when nobody asks where the metal is. So let's break down who you are watching this right now, because one of three things is probably true. You might already own silver, coins, bars, maybe even allocated storage. You've been patient for years. You've watched silver go nowhere while everything else screamed higher. And now, suddenly, the price is moving and you feel that mix of excitement and dread. You remember the smashes. You remember the rug pulls. You're thinking, they're going to do it again, aren't they? Or you're curious. You don't own any silver. You've heard the whispers. You've seen the charts. You're trying to figure out if this is the start of something real or just another hype cycle. Or maybe you're skeptical. You think this sounds like doom content. You think markets can't be rigged because surely regulators would stop it. You think if silver was truly scarce, the price would already reflect it. Whichever one of those you are, stick around, because understanding what's happening in the silver market isn't just about making or losing money. It's about seeing the mechanics of our financial system under stress. It's about asking what price really means and what money really is. The narrative for silver has always been this epic battle between paper and physical. For years, paper has been winning, but what we're seeing now are cracks in that dominance. The physical side is pushing back in ways we haven't seen in a very long time. This isn't just about a commodity anymore. It's about trust. Trust in the paper contract, trust in the exchanges, and trust in the price you see on the screen. When your Uber driver is talking about margin requirements, it means the conversation is changing. It's moving from the niche forms of silver bugs and into the mainstream consciousness. And when that happens, the old playbook might not work anymore. The kill switch but might fail if the power source, the physical metal itself, has been disconnected from the paper circuit. This isn't a prediction of what will happen next. It's an observation of what is happening now. The pressure is building. Whether that pressure releases in a slow hiss or a sudden pop is what everyone is waiting to see. The numbers from the COMEX, the lease rates, the premiums on coins, they're all just pieces of a much larger puzzle. And for the first time in a while, it feels like we might be getting close to seeing the full picture. Then people started pointing at who was issuing delivery notices. One name pops up again and again in the commentary: JP Morgan Securities, reportedly issuing hundreds of contracts in a single day, something like 299 contracts, which would be nearly 5 million ounces. Now, pause. Ask yourself, why would a major bank suddenly be so active on the delivery side? If you believe the narrative that no one wants delivery, why are they delivering? If the system is calm and healthy, why is metal moving like that? One interpretation is simple: covering. Not in the sense of closing a trade on a screen, but in the sense of making sure they have their obligations squared away before a bigger delivery month hits. Because March is coming, and March is a primary delivery month. So if a minor month is already pushing historic levels, what does that imply about the next major month? It implies stress. It implies people are choosing metal over paper. It implies the market is testing the system's ability to deliver. This is where the historical echo becomes loud. In 1980, the Hunt brothers tried to corner the silver market. The exchange responded by changing rules, raising margin, and restricting buying. Whatever you think about the Hunts, the lesson is clear. When the system is threatened, it uses the levers it controls. And margin is one of the strongest levers because it doesn't have to argue with you. It just liquidates you. And yes, people bring up JP Morgan's past all the time, including the massive precious metals manipulation case that ended in a $920 million penalty in 2020. You don't need to love conspiracy theories to acknowledge a basic fact. When huge institutions have been punished for manipulating a market, you should stop pretending manipulation is impossible. Now layer on the other signal that's been lighting up everyone's radar: the physical price gap globally. If you're in Shanghai, the number people are repeating is around $132 an ounce for physical. Tokyo, around $140. Dubai, around $130. Other hubs quoted slightly lower. Kuwait, around $120. Seoul, around $118. And then the paper price, $115, sits there like a mask. Do I know every local quote is perfectly accurate down to the dollar? No. Physical markets are messy. Premiums change by product, delivery terms, taxes, currency conversion, and local scarcity. But when the conversation everywhere is physical costs meaningfully more than paper, that's not noise. That's trend. This is what some traders call the great divorce: paper pricing separating from physical reality. The paper market can print a number. The physical market demands metal. And metal does not appear because a screen says so. Now, let's talk about inventory, because this is where the story gets hard to ignore. People are citing data that in the first 2 weeks of January, about 45 million ounces of silver were withdrawn from COMEX vaults. Some claim that's around a quarter of registered inventory in a short window. And zooming out, the narrative is that since 2020, registered inventory has fallen more than 70%, from roughly 346 million ounces to under 100 million. Again, don't take any single number as gospel without checking. But ask the more important question: are vault stocks trending down over time while demand rises? Many datasets suggest yes. If registered inventories shrink, the system has less cushion. The smaller the cushion, the more sensitive the market becomes to delivery demand spikes. And then we arrive at the ratio that makes people go quiet: paper claims versus physical metal. Analysts throw around different numbers. One that keeps getting repeated is approximately 356 to 1, meaning for every 1 ounce that could realistically be delivered, there are hundreds of ounces of claims floating around in futures, options, ETFs, swaps, and various derivatives. Is it exactly 356? I don't know. But the concept is real. Paper exposure can dwarf physical availability. To the first group. Your fear is understandable. If you've been in this space long enough, you've watched silver get smashed on no news. But fear is exactly what forced liquidation is designed to harvest. It shakes out weak hands and transfers positions to entities that can survive volatility. To the second group, your job is simple. Don't take anyone's word for it. Not mine, not anyone's. Verify the margin notices. Look at delivery data. Look at inventory reports. Compare physical premiums from reputable dealers and international markets. Get obsessed with evidence. To the third group, keep your skepticism. It's healthy. But be skeptical in both directions. Be skeptical of everything is fine narratives too. When a market needs emergency levers to function, that's a signal worth investigating. Now, I want to share a warning story that's been circulating as a preview of what happens when margin changes hit fast. The claim is that in India, specifically in a major silver trading hub, dozens of trading firms were wiped out in a week, with hundreds of millions in losses, after volatility and margin pressure hit at the worst possible moment. Whether the exact count was 44 firms or a different number, the lesson is the same. Paper markets can destroy good traders overnight when the rules change and liquidity disappears at the same time. And that's the point. This isn't about being smart. It's about being solvent. It's about having enough cash to survive moves you can't control. So what happens next? There are basically two broad outcomes. Outcome one, the paper price rises to meet physical reality. That means silver rips higher, shorts suffer, and the margin hikes fail to stop the move. The market forces honest price discovery. If this happens, it will be brutal for anyone trapped on the wrong side with leverage. It could stress institutions. It could create cascading problems in derivatives. Outcome two, the split becomes permanent. The paper market continues to show one price, while physical trades at another, and more participants ignore the paper price as a reference. In that world, the paper market becomes a casino for speculators, while the real market happens elsewhere, in real metal with real settlement. Either way, the person holding actual metal is not subject to a margin call. Physical doesn't get liquidated because an exchange adjusted a formula. Physical doesn't vanish because a broker button got pressed. Physical is boring, which is exactly why it's powerful. Now, I need to add balance here, because if anyone tells you it can't go down, they are either naive or they are selling you something. Silver can crash. It has crashed before. After the 1980 peak, it collapsed and took decades to recover. Manipulation can continue longer than you think. Institutions can change rules, coordinate narratives, and survive pain that would kill a regular trader. So yes, you could see a savage pullback. You could see a brutal shakeout. You could see headlines that make you question everything. But you should also notice what's not normal right now. A rapid margin jump to around $52,000, physical premiums that won't disappear, inventory drawdowns that keep happening, lease rates, screaming tightness, and an atmosphere where the market feels like it's holding its breath. One more lever has people furious. Moving to percentage-based margin instead of fixed dollars. The idea is that silver margin becomes a percentage of contract value, say around 9%. That sounds fair until you realize what it does in a bull market. If the price rises, the margin rises automatically. You can be right on direction and still get forced out because the collateral requirement keeps climbing with the price. That's not risk management for longs. That's a built-in squeeze on participation. It's gatekeeping via mathematics. It ensures that as silver gets more valuable, fewer regular people can afford exposure in the futures arena. And that's why so many voices keep repeating one sentence. You don't have to play their game. Because physical silver doesn't care about percentage-based margin. It doesn't care about maintenance requirements. It doesn't care about overnight notices. It just sits there. Now let's talk about another strange behavior being discussed. Traders rolling backward. Normally, futures traders roll forward, closing the near month and opening a later month to maintain exposure without taking delivery. But when trust breaks, behavior changes. Some claim traders are moving from later contracts into nearer ones, trying to pull delivery forward. Why would anyone do that? Only one reason. They want the metal sooner because they don't trust it will be available later. If enough participants behave like that, the exchange faces a moment of truth. And if an exchange can't deliver, it has a last resort. Cash settlement, force majeure, whatever label they choose. The moment the system admits, we'll pay you money instead of metal, the illusion breaks for anyone who thought they owned silver. And that's why, for decades, the paper system has relied on one thing. Most people never ask for metal. Now zoom out beyond the trading pit. There's a macro backdrop here that matters, even if you're not a macro person. People have been pointing at gold making new highs. Some are quoting numbers above $5,000 an ounce in this narrative, and tying it to political statements and currency confidence. Whether or not you accept every specific price, the broader idea is consistent with history. When confidence in fiat wobbles, gold moves first. Silver tends to follow, often later, often more violently. Silver is also different from gold in one critical way. It's industrial. It gets used up. It's not just stored. It goes into solar panels, electronics, medical applications, batteries, and the infrastructure of modern life. When silver is consumed, it doesn't always come back to a vault. It gets dispersed, recycled imperfectly, and effectively removed from easy supply. This is why the multi-year supply deficit matters so much. Commentators have said silver has run a deficit for about 5 consecutive years. Some cite a cumulative deficit since 2019 exceeding 3 billion ounces, and projections that 2025 could be one of the deepest deficit years on record, approaching 300 million ounces. Again, check the data, but don't ignore the pattern. If the world consumes more than it mines, the difference comes from above-ground inventory. And above-ground inventory is not infinite. Now add geopolitical and policy pressure. There's talk about export restrictions, refined supply concentration, and state-approved producers controlling a huge share of output. Even if the exact percentage varies, any move that limits export flexibility tightens the market and raises the value of accessible inventories elsewhere. So when you hear physical premiums are exploding, it fits the broader picture. Real-world supply chains don't respond instantly to paper price signals. If refineries, mints, and logistics are stressed, local prices can detach. Now, I want to explain why the $52,000 figure is psychologically important. Humans feel numbers. 10% margin on a $575,000 notional contract is a gate. It tells you the exchange wants fewer participants. And when participation shrinks, it becomes easier for large players to control flows. This is why the margin move feels like they made it illegal for you to win. Not literally illegal, but practically, because the requirements exclude the crowd. So what do you do with this information? First, stop treating the screen price like a sacred truth. Treat it like one data point. If physical markets are paying meaningfully more, that's not automatically bullish forever, but it's a sign the paper quote is not the full story. Second, understand your exposure. If you're trading futures, know what a margin hike does to you at the worst possible time. Don't assume you'll get a warning. Don't assume you'll have time. In fast markets, you don't get time. Third, understand the difference between paper exposure and physical ownership. Paper gives you liquidity and leverage. It also gives you counterparty risk and rule change risk. Physical gives you no leverage and no margin calls. It also gives you storage concerns and spreads. Every choice has trade-offs. But you should choose consciously, not accidentally. Now, let me be transparent about something. I don't want chaos. I don't want banks collapsing. I don't want markets breaking and people losing jobs. What I want is honest price discovery in a market that doesn't require tricks to function. Because when markets rely on levers like sudden margin hikes to stabilize, what they're really doing is transferring risk. They're shifting pain from the system onto participants who can't defend themselves. And that brings me back to the simplest, most uncomfortable truth. Wealth transfers happen when systems break. When the plumbing fails, assets move from the unaware to the prepared. So here's a realistic way to think about the coming months in this narrative. In the near term, January and February, expect volatility. If silver is in a squeeze setup, you'll see violent moves up and down. You'll see margin changes. You'll see scary headlines. You'll see commentators calling it a bubble. That's the shakeout phase where people get emotionally exhausted. Into March through May, if delivery demand stays elevated and physical premiums persist, pressure builds. The paper market may try to push price down, but if physical keeps getting taken, the tension grows. You could see silver testing the $120 to $130 zone on the paper, quote again, with mining stocks starting to wake up. Into summer, if inventory drawdowns continue, the conversation shifts from conspiracy to availability. The only thing that makes mainstream media change its tone is undeniable evidence in the real world. Delays, shortages, rationing, rising premiums, industrial buyers complaining. And by late year, if a currency event, geopolitical shock, or supply disruption hits, while the silver market is already tight, you could see explosive price discovery. Some people throw out targets like $175 to $200 silver. Maybe that's too high. Maybe it's not. What matters is not the exact number. It's the recognition that in a stressed market, prices can gap and overshoot because paper is trying to catch up to physical. But remember, this is not a straight line. It never is. The market will try to punish certainty. It will hurt the crowd on both sides. It will make you doubt your own eyes. That's why the real move isn't some magic trade. It's understanding the game and choosing the arena you want to play in. If you insist on leverage, then you must respect margin. You must size your position like a professional. You must assume the rules can change. You must assume liquidity can vanish. You must assume the exchange can protect itself before it protects you. If you don't want to play that game, then you position in a way that can't be margin called. That might mean physical. It might mean fully paid vehicles. It might mean strategies that accept slower gains in exchange for lower fragility. Because fragility is what the system exploits. And yes, I'm going to say it clearly. If the exchange is moving toward percentage-based margin, then a rising silver price will automatically squeeze leveraged longs. That is the definition of a structural headwind for retail participation. It means the higher silver goes, the more cash you need just to stay in. That is why people feel like the table is being cleared. Now, I want to end with a challenge. Don't believe me. Don't believe anyone on the internet. Believe documents, believe data, believe behavior. Look up the margin requirement notices. Look at the delivery reports. Watch registered inventory. Track lease rates and term structure. Call a dealer and ask what the premium is on real bars in your region. Ask how long delivery takes. Ask whether supply is improving or tightening. Then ask yourself one honest question. If everything is normal, why does the system need a $52,000 gate to keep traders from holding long positions? If everything is fine, why does physical keep pricing above paper in multiple hubs? If everything is healthy, why do people keep talking about delivery stress, backwardation, and rising lease rates? Maybe it's nothing. Maybe it resolves quietly. Maybe inventories stabilize, premiums compress, and the margin hikes prove justified. Or maybe we're watching the early stage of a two-tier market. where the paper price becomes an advertisement and the physical price becomes the truth. Either way, you deserve to understand the risk before you step into it. So here's my final thought. The trap isn't silver. The trap is believing the rules are fixed. The trap is thinking the game is neutral. The trap is assuming the screen tells the whole story. When you recognize that the rules can change overnight, you stop building strategies that depend on stability. You stop treating leverage like a cheat code. You stop confusing a paper claim with an asset. And then you make your own choice based on your circumstances, your risk tolerance, and your timeline. If this opened your eyes, share it with one person who still thinks silver is just a sleepy metal. Share it with someone who believes markets can't be steered. Because the moment regular people start understanding the plumbing becomes the story. Remember the numbers being repeated: around $140 in Tokyo, $132 in Shanghai, $130 in Dubai, and $150 on the screen. Whether those exact quotes hold tomorrow isn't the point. The point is the gap. The point is the confession hidden inside the premium. If you want updates, follow this channel. Stay alert, stay grounded, stay evidence-based. And whatever you do, don't let a margin notice decide your future for you.